All right, Colton, you ready?
Ready.
Let's do it. Investors, welcome back to the channel. I am extremely excited here today to have with me Colton Lukey, who is a multi-millionaire here joining us, been free for 3 years now financially. And there is no better time to interview Colton than right now. I mean, we are heading into a remainder of 2023 here that can produce a lot of opportunities for all of us. And a man like Colton is going to deliver through on a lot of insights for all of us, not only on dividend investing, but real estate. And we may even get some lucky dimes here when it comes to crypto as well. But I'd like to welcome to the channel, Mr. Colton Lukey. Colton, thank you so much for joining me today. I want to fire away with a hot seat question, if you don't mind. The first question here. Are you ready for this one?
I'm ready.
We want to know, what is your net worth as of this moment?
All right. Well, first of all, thank you for having me on this podcast. We've been trying to get at this for a while, and we finally made it happen. So right now, to break it down, dividend portfolio is about 600,000, and the real estate portfolio total value is pushing close to 5 million.
Let's go. So just to say that again, we're pushing about $600,000 within the dividend portfolio. Can you just say that number one more time with your real estate portfolio?
It's getting close to about 5 million.
5 million. And Colton, how old are you?
Just turned 31.
Just turned 31. Well, happy birthday to you, just turning 31. I hope we're not too late in the game. I have to know, and I'm sure many of us out there are dying to know. First of all, I'll be honest, I just found your channel not too long ago, but I was blown away because, of course, in your channel, you talk about dividend investing, which, by the way, everybody go check Colton's channel out. The link there is going to be in the pinned comment down below in the description. But nonetheless, I was completely blown away when I found your channel for two reasons. One, you're a dividend investor and you've been doing a standout job in terms of dividend investing, but you're also heavily involved in real estate and you're quite young. I mean, 31 years old. And I think you hit financial freedom at 28. Is that correct?
Yes. Yeah, that's correct.
I want to go back and just rewind back in time here. Take us back to like the early days of Colton Lukey, how you got started. What's your story? What's the background here?
Sure. Yeah. So I guess as I look back on the early years of my life, what I see now is I was always very entrepreneurial. I was always trying to make money, rather it was shoveling driveways, right, for snow, cutting lawns when I was 12 years old, buying and selling, Pokemon packs. That was a big thing, right? And saving all the money from birthdays and from all those little side jobs. And I really started getting interested in investing when I was 16. The reason for that was there was this thing that happened in 2008 and 2009. And it's a little tiny thing, right? And it was all over the news. And not that I was watching the news, but my father, who's not really an investor, he's an electrician by trade, but always liked to watch Mad Money, Jim Cramer, right? Sure. So that was on the TV every single night. And I just, from hearing this, everything's collapsing, right? And it kind of got me interested. And at the age of 16, something piqued my interest. I don't know what it is. It might have been a light bulb moment, but I heard this guy by the name of Warren Buffett who bought American Express stock. And he was the richest man in the world. And I was like, huh, cool, okay. And then the stock went up like 8% in a day when he bought it, right? It was like $5 or $6 and it shot up a bunch and it was just ridiculous, right? So me having like $1,000 when I was 16 saved from working jobs and like I mentioned earlier, I was like, you know what, maybe I should try and make an extra $1,000, right? How hard can this be? So I wanted to invest in the stock market. I couldn't because I was 16. So my father had to open up a brokerage account in his name, deposit my $1,000, and I ended up buying the same thing Warren Buffett bought, which was American Express. And American Express, I think, was then around $10 or $11 a share. And at this time, the Canadian and US dollar was equivalent. So for your viewers, I am Canadian. I do live in Canada. And that was my first stock investment, was at the age of 16, American Express. A year goes by. I think I sold it for around $20. So I made my $1,000 and then I went on a vacation with some friends when I was 17, 18, right? You go to the summer.
And there it goes.
And there goes the money, right? So, but at 17, hey, I had an extra $1,000 in my pocket. Why not, right? And then fast forward a little bit later, in college, I started getting more interested in stock market investing. I started getting really interested in real estate investing because I always wanted to be my own boss. That was like my goal since I was young. I was like, I do not want to work for someone my entire life because I always hear people complaining about their boss or their coworkers, right? So this is something that resonated with me. And that's where I really stumbled upon real estate, right? And I started learning everything about real estate, and I was Googling back in 2012 how to become a millionaire the fastest. And everything that came up was real estate. So that's when I started focusing on it. I started learning about how you only have to put down 5% here in Canada to buy a property. So I was working 2, 3 jobs throughout college and everything like that. Still doing some stock market investing. I was buying Enbridge and some Canadian banks and stuff like that in what we have a TFSA account, which I think is very similar to your Roth IRA.
Yep.
And that's kind of the beginning story of how I got some money by working and a little bit of investing and was able to then use that money towards a down payment and buy my first piece of real estate.
Wow. And that first piece of real estate, was that a single family, multifamily? Was it
Yes, this was the most important thing.
that
The
real
most
estate
important thing was I learned that when I got out of college, I got a job and I was making $15 an hour, which back in 2014 was, I guess, okay, but it wasn't great. So, but for some reason, the bank approved me for $200,000 for a mortgage. So I
they
was
knew
like,
who you would
cool.
become? That's it.
Right, exactly. So I ended up buying a 2-unit property. So my girlfriend and I, who's not my wife, we renovated the basement apartment and moved into the basement. And then we rented out the upstairs. We were living 100% for free. We were actually making a little bit of money because the rent was about $1,600 upstairs, and to run the property was about $1,400. So we were living for free, and we were saving as much as possible, and we were just building equity in that first property. And then from there, took the equity out and just repeated the same process.
Wow. Well, I got to ask, so, I mean, again, you started quite young, especially in real estate. And oftentimes what I hear, especially when it comes to investors, not even just younger investors, but older investors, is they have this fear. And again, full disclosure, like for me, when I look back to when I was 16, even earlier, right? I started working all these odds and ends, neighborhood jobs, shoveling driveways, pulling weeds, waxing cars. I had such a fear of putting money even into the bank at like 7 or 8 years old. That fear was crippling, by 16, 17, when it came to the stock market. It was so perplexing for me at that point in time. I didn't read up on anything. Like, yeah, I knew Warren Buffett and the alike, right? Peter Lynch and all those guys, but it was like, oh, that's for them. And I'll get invested in due time. And what it really was for me was fear. And I want to know, like, if you could think back, did you have any initial fears, or was it more just like a dare, risk it all type of mentality?
I didn't have anything. It didn't come from much, right? So the most I lose was what I had, right? Which wasn't a whole lot. So for me, it was I just wanted to be a millionaire so bad and financially free that I would just take a risk, right? Like when I bought the first property, I had only $12,000 in savings, and that came from working 2 and 3 jobs, right, while in college and everything like that. To close on that property was about $13,000. I took $1,000 cash advance from my credit card because I didn't realize I had to pay for the lawyer too, right? And then to renovate this property, I was relying on credit cards and lines of credit. But for me, if the bank was going to give it to me, then I guess it kind of makes sense for me to do it. And again, I didn't have much to lose. So for me, I just went, kind of balls to the wall, and nothing really. I had fear, of course, but I don't know if it was fear, but it was just so much determination. I just wanted to become a full-time real estate investor and invest in the stock market and be a millionaire.
It's almost like as we get older, I feel like we get even more fear. Quite the opposite happened for me, right? Like when I was just entering college, I decided to actually start with index investing. That was incredibly safe. Slowly but surely, I started to build the portfolio that I have now into more of the dividend portfolio. But again, that underlying fear was there. And actually, it took a couple of times, a couple of investments that I made some money here, I lost some money there. But ultimately, through experience, the fear just faded away. And what I love about this story right off the bat is like, you had that young mind kind of fearlessness with you, and you risked it, and it worked. but often like even the investments I have today, right? Like one of the biggest, I think, mistakes looking back on my investment journey was I was too safe. And playing it too safe will not yield you as much of a return. I want to know, though, from someone like yourself, what would you say is a very common investor mistake that's either made in the very beginning of someone's journey, or even if they're more experienced? Like, what would you say is a very common mistake that investors are making?
So for two things. So I was, in my opinion, too safe as well. As I look back, I was too safe, especially when interest rates were at 0%. I was way too safe.
Sure.
When it comes to stock market investing, selling your winners too early. That was my biggest mistake. Like, I could easily be worth $1 million more had I held on to just Facebook and Nvidia over the last 3 months.
Sure.
Right. But not to mention, there was just countless times where I maybe made 25, 30% in the span of a year and I sold it.
Yeah.
Now, you can never go broke taking a profit, but as I look back, had I held on to those a little bit longer, I probably could have used those funds. Because what I do, right, or what I do is I accumulate cash, right? I accumulate cash, rather it's in a safe dividend portfolio. I just accumulate this cash. And then when that right property comes for me, I have no problem selling out of that dividend portfolio and putting it into real estate, because real estate has proven to me that it's safe when you buy it right, but you're using other people's money because the bank's going to give you a loan on it, right? And you're able to use leverage. So to me, the fastest way for me to get to that millionaire status and to get to, wealth was through real estate. So when I look back at fears, the fears for real estate for me were I don't think I bought enough when I was younger. Because I know, of course, you can't go back. What I know now, there's many properties where I walked away from that I should have bought.
Sure.
But the same thing can be said. So a little other story for your viewers. I'm not sure how much you've done digging in my background, but we sold off. So we lived in Ontario, Canada, which is a province. We lived in an area near Niagara Falls, which I'm sure everyone probably knows what Niagara Falls is. So at that time, we had about 10 or 11 properties, duplexes, triplexes, stuff like that, including our home, which was a duplex. In the summer of 2021, I started seeing a lot of red flags in terms of properties were going way over asking, $100,000, $200,000 over asking. Inflation was starting to creep up. And I knew that the only way to bring down inflation was to either stop printing money and to raise interest rates.
Sure.
I don't think they're going to stop printing money, but I know they're going to raise interest rates. So we actually sold off our entire portfolio between December 2021 and the last one closed June of last year. And we took that money and we moved across the country to a better area. So that risk, where we never been before, I've never been here. We went here once to buy a property. We packed up everything and left. So risk is all dependent on the individual, right? And it really comes back to, what are you risking, right? If you have nothing, you're not risking much.
Sure. But some people would argue, right, like that their $1,000, that they've worked so hard for the 1,000, or, there's been so many people that I've heard, right? I don't want to invest because, I'm going to lose the money in the market, or I can't invest because I only have, X amount. So I feel like they feel like that's what they've earned. And if they risk that, they'll have absolutely nothing. But what you're sharing is like, you almost have so little that you have to put those chips on the table.
Well, you're never going to save your way to retirement. And what people have to understand is they just continue to print money. So money is garbage, right? Money is 100% garbage. It's useless. But what you want to do is take that money and put it into something that grows. Rather it's a blue chip stock, rather it's a piece of real estate, right? And the reason I love real estate is simply because, well, I'm rich, I get depreciation. And do you know what your two biggest expenses are? What do you think the two biggest expenses are for people in everyday life?
Expenses today, rent's got to be one of them.
Okay.
I'd go with cost of living's up there.
Everyone forgets about the biggest expense usually, and that's taxes. So if you can eliminate if you can reduce your taxes legally, and you can live for free, house hack by buying a duplex or a triplex and living in one unit, rent out the other, you right there will automatically save money. You don't have to work any harder.
You heard it here first. We're done with the interview.
Right?
But you want to be financially free.
right? It's dissecting money is what it is, right? And understanding what money is. Money is just a tool, right? And they just keep printing it, which means it's becoming less and less valuable. So holding on to money is useless. Sure, you need some money for an emergency fund, whatever. But if you hang on to too much of it, you're just going backwards because it's going down by 10% a year. So by not investing, you're risking.
And you're losing, essentially.
And the way to reduce risk nowadays is by taking risk.
Yeah. You know, it's funny. It always takes me back to this quote. And essentially, right, like, again, if you're not risking, that's the biggest risk of all. That's first and foremost. But also this quote here of, it's never how much you make, it's how much you're actually able to save, but moreover grow.
Correct. Yeah.
And so you're able to negate the taxes, right? Yeah. And I want to go now. So, okay, you mentioned an emergency fund as well. And I'm curious to know, so for me, what I started off with is a $10,000 emergency fund. I call it my lemon fund. I still have it today. To be honest with you, I've never touched it, right? Like life has never yet handed me lemons, but that day might come, right? How much would you say, though, is an ideal amount to have in an emergency fund? And how much is too much in there, playing it way too safe?
If you don't have anything, there's no point in having an emergency fund, in my opinion. Right? In my opinion, I look back, so many times I went down to zero. I went to negative. That first property, I took $1,000 credit card loan, right? I didn't have anything. So what your worst case is you're going to have to put on a line of credit. So nowadays, like we have, I guess you can call it an emergency fund, but what it is, it's a capital reserve fund for real estate. We have roofs, furnaces, stuff like that, right? Obviously, but that's not our personal emergency fund. What you have to understand is you have to start buying assets. Your emergency fund is going to come from your passive income sources. It's not going to come from a little bit of savings in the bank. And how many emergencies, like you just said, have you had? None, right? Now, of course, you might have one. Here in Canada, I guess we're blessed because we have free healthcare. It's not free, it's all taxed, right? Like we're the highest taxed country in the world, one of them, right? But my American friends that I know, they just have really good health insurance policies that they pay for. Right. Sure. And then if their deductible's $1,000, they'll keep $1,000. They invest everything else. Right.
Insights.
Money is what people don't understand is they think money's scarce. Money's everywhere. It's unlimited. It literally is unlimited because they just keep printing it. So there's no point of hanging on to it. It has to be invested.
So assuming these were more like lessons for you over time, right? Because you probably weren't thinking like this at the onset of the journey.
Correct.
So what would you say?
Like how everyone else thinks.
What would you say is like the biggest lesson learned the past decade for yourself? You had to narrow just one lesson for yourself.
Don't be scared to take risks. If you don't take risks, you're never going to get ahead. That's it, right? Like and I still think I should take a heck of a lot more risks even today. And there's still little things pulling me back that I'm just trying to break through. Like right now, we're looking at a $4 million deal. $4 million. Our entire net worth is probably 4.5, 5.5. We're looking at a deal that's going to be most of our net worth. That's risk. And I'm trying to just get over that.
Sure.
Right? Because I know when I break through that barrier, all it is a barrier. Then the next thing is probably going to be 10 million.
Let's take off. It's like Grant Cardone's 10X.
100%.
Right? Yeah.
Yeah. You just got to break through barriers, right? Like for me, there's a whiteboard behind me. And that whiteboard has been with me for 12 years. And I just I wish that thing had a recording device on it.
Is there anything on it right now?
There's nothing. I just erased it because we just finished a refinance on a property. So I had all that stuff on there. But even, like I have a booklet. You just write your goals down and make sure you accomplish those goals, right? Like just get after it as much as you can and just stay focused 100%.
I love it. So it almost sounds like in this case, right? When someone's to start out, because my next question here is like, so predominantly a lot of my viewers are dividend investors, but a lot of them, probably honestly like 90% of them are seeking financial freedom. Why else would you be a dividend investor if you're not interested in financial freedom and passive income? Now, real estate, what I love, when I still lived in the US there in Manhattan, I was working for a real estate firm, managing 2 towers there. And I'd always, like sit with the owners and just try to take in so much. And what I've learned from them, is like, well, where do you start? Is you just start looking for property, you start looking for the quality deals. But in this case, what would you say is the most ideal for an investor to get started today? Would you have them start off in real estate now? Because the market, as we know, is as it is now, mortgage rates through the roof. Or would you have them actually start building this dividend portfolio and waiting for a better opportunity?
So I say before actually buying into real estate or stocks, I would say you have to first surround yourself with the right people. If you're still hanging out with, losers, you're going to be a loser, right? So if you want to surround to go back on your point, I think the thing for me too was I surrounded myself with people who are way ahead of me. Most of my friends now are 60 years old. I'm not kidding, right? Most of my friends are 60 because I learned from them when they were 50, right? Yeah. So surround yourself with the right people. But in terms of what you should invest in, dividend stocks or real estate, obviously if you can do both, great. But I don't think there's anything wrong with this market for real estate because it's taken a lot of people out of the market.
Yeah.
Right. Like, yeah, interest rates are higher, but you can get an interest rate for, at least here in Canada, 6.25 to 7%. Historically, the average is 5%. So we're not at 10, we're not at 15, sure. Right? We're a little bit above average. So everyone's freaking out about interest rates. It's like, guys, the average is 5.5%. Really not that bad, right? Sure. So the competition's less in real estate right now, in my opinion. I still think that you can get properties that cash flow, whether it's a house hack like a duplex or a triplex where you only have to put down 3.5%, 5%, and you live in a unit rental with the other two. That's your best thing because you're going to buy an asset, let's say a $200,000 asset for less than 10 grand.
Yeah.
You're going to live probably for free or pretty darn close to it. So you just eliminated two of your biggest expenses in life, right? Should people invest in dividend stocks? I would say it doesn't hurt to start doing that, but understand that investing in dividend paying stocks is probably going to take a lot longer to hit financial freedom, especially if you're a low income earner. I never made more than 50, 60 grand in my life, my day job, right? So if I was making $250,000, $300,000 a year, yeah, I could probably just buy 100 grand worth of dividend stocks every year, and in 10 years got $1 million. Cool, right? Would have grown, compounded, probably worth $3 or $4 million, no problem. Sure. So it really depends on the individual as well, right? And what their income level's at. But I would say don't be scared of this environment for real estate because there's tons of deals out there, low competition. And stocks, buy what you know. Something I learned from Peter Lynch was one of the first books I read about stock market investing. I think it's called One Up on Wall Street.
Yep.
And he said, buy what you know. So when I was 17, 18, I was working in a grocery store. They matched 6% of all my contributions in stock options. I was looking at this chart, 30 years, a chart went like this. I'm like, oh, okay, I'll buy that. I know this business. I know they're growing. I know they're opening up 3 more locations, right? It's insider trading without insider trading, right? Yeah. So if you're working at a company that gives you stock options, look at the performance of the company. If you work for Walmart right now, take the damn stock options, right? If you work for McDonald's, take the stock options. Starbucks, take the stock options. Coca-Cola, right? You know that business. You know it's a damn good business. Take that, right? And then you're already investing in the stock market with that without having to put extra money into it.
Yeah, what do you think? Do you think it's a lack of education, like financial education that's out there? Or do you think it's fear? Or do you think it's a combination? Because I feel like, today it's just, you can't not go on YouTube and, just so simply now find a 2-minute video or 5-minute video, shorts, less than a minute, right? About McDonald's stock, investing, $10,000 McDonald's stock. Where is it in, a decade's time?
Yeah. No, I think it's,
which one is a bigger trigger for people?
I honestly think it's both. I mean, lack of education, 100%. I think people are just lazy.
Sure.
I think people are extremely lazy nowadays and don't want to prioritize the most important thing, which is business, right? Obviously, health is number one, but like if you can't put food on your table and you can't support your family, you're gonna have bad health anyway, right? So sure. I think it's lack of education, a little bit of fear, I guess. Sure. I think far too many people listen to the wrong people. Like had I listened, I love my parents to death, but had I listened to them when I bought that first property, they told me don't do it, I never would have bought that first property. I never would have bought the second property or the third property, right? Because 25 years ago, they could have bought that property for $75,000 and I was paying $220,000, right? So where you get your advice from nowadays is very important. Social media's got good and bad. There's too much garbage on there, right? But then there's also a lot of good stuff on
Sure.
So I think it's a combination of many things, right? And I think a lot of people just rather go buy the Gucci handbag than put $2,000 into the brand that owns Gucci, right? Right, the stock that owns
You
Gucci.
want to look good. It doesn't actually matter what's in the bank account. It's just the
Most
Gucci
people are
belt,
pro. And what
the
I've learned,
Louis
most
shoes.
people, yeah, that, and I'm not, most people that I think are really flashy like that are broke, right? Just from my personal experience, just going out for dinner with people who they got a couple Rolexes and they got a Corvette and they got Beamers and all this, but then it's like, oh yeah, we'll grab a bottle of wine.
Yeah.
Oh, bottle of wine. Whoa, whoa, whoa. Right? Like I thought we were gonna have a nice dinner here, right? We haven't seen each other in a long time, right? We're gonna catch up or something, right? You gotta watch out where you get your information from because
Yeah.
it's credit's so easily available now, and they do give loans to just about everybody that anybody, as long as they're making 14, 15 bucks an hour, can probably get a loan for a Mercedes or an
Yeah.
Audi, right? You can finance anything nowadays.
In 2019, I had this goal of reading a book a week. That was my goal in 2019. And what did I immerse myself in really was reading about the millionaire mindset, right? Very similar to you, just not as risky, at least back in my earlier years, right? I was reading all about it. I was like, oh, this is great. I just never did anything. I never took the action. So
Analysis
shame on
paralysis.
me, but it's a game of catch up at this point. What I can say though, that year was transformative because every week I was reading a book, and one book that ran with me the entire year was The Millionaire Next Door. I'm sure you read it. It's a fantastic read if you haven't read it already. But The Millionaire Next Door talked about essentially the mindset, right? Of what that millionaire really purchases, how they really spend their money. And to your point, they don't buy the flashy watches and the shoes and the belts. And actually, even working in Manhattan real estate, and sitting across the table from some bigwigs in Manhattan, what I always realized was the more successful people were, the less flashy they were, and the more frugal they were, which was a huge takeaway for me. And I want to go back now to your girlfriend, your wife, but it sounds like when you first started off, I mean, you must have had a tremendous partnership then, because it's only transformed now into a real partnership, a marriage. And that's a very beautiful thing. I think it's so important to find a partner that is going to be there to support you, but also understands the financial edge that you're going to be taking, or the steps that you're going to be taking. And I spoke about this with a couple of different YouTubers on a couple of different interviews. The Dividend Diplomats being one, and both of them mentioned how their wives were actively involved in their investment portfolios. I hope I'm not, poking around too much, but I'd love to know, what's your wife's name?
Alejandra.
Alejandra. I'd love to know, when you and Alejandra were dating, the very beginning, like, did you have any financial conversations? Did you say like, hey, Alejandra, just to let you know, I'm on track to become a millionaire and I'm going to take a lot of risks, and you're either with me or you're not? Like, how did you guys partner together and work together financially?
Yeah, so to give you some background, she came here to start college at 16 from Columbia. She was an international student on scholarships.
Wow.
Right? So she came here with not a whole lot. She had a family member here that she was living with at the time, right? Like an aunt. And we met in second year of college. So she was 18, I was 20. And the first months of dating is all, oh yeah, let's try this, let's try this. I want to show you this, this, and this. But as things got serious, you start telling people what your goals, right? Like, everyone wants to graduate college and go to the job. I said, I want to get out of college because I can start making money and buy real estate, right? And I told her like that was up front, and she supported that. And I wouldn't be where I am today without my wife, 100%, right? Because the support there, you do need a partner, right? And you're going to have business partners, but you need a partner at home, right? And she's just as involved in the business now as ever, right? So we built this thing together because we knew that we didn't come for money, right? We wanted to enjoy more of life. We wanted to make sure our parents didn't have to work till they were 65, 70, 75 years old. We wanted to try and, take that down a notch so then they can enjoy life too.
Sure.
We had, she has siblings that we wanted to make sure were okay and taken care of. So we were very focused around money. And looking back, we split, the most important thing, we split everything 50-50, right? And I know a lot of people might be thinking like, oh, that's not very, manly. Man should always pay for everything. Listen, when you don't have much, you got to do something, right?
Sure.
So we split everything 50-50. When we moved in together, we split rent 50-50. When we went out for dinners, insurance, stuff like that, it was all split. And we had this goal where we wanted to just try and get ahead financially, right? So when we bought that property, she was trying to tear down drywall too, and she helped me paint and all that, right? Tried to lay floors, and it was just really this thing. It wasn't easy. There was times where, I'll be honest, we probably almost broke up a couple of times because the stress around the money, right? Because we just went so fast and we had nothing in the bank, right? That can bring a lot of stress. But I think it shows the connection we have because we got past all that,
Yeah.
right? And now we're going on 11 years of being together and married for going on 3 years.
Beautiful.
And it's not easy, right? Like, I don't know if you're married or what your situation is, but marriage isn't easy, but you do have to have a partner, I think. And I think that partner it really gives you guidance. It calms you down when you are going through stressful financial times, and you're going through anything stressful.
Sure.
Just having that person there to talk to comfort you, to love you, and support you, I think is very important.
I love that you said that. I mean, my girlfriend, in the other room right now, but I can share with you that the days that are the hardest at work, or the days, right, that I'm trying to take the risks, or the next steps for the future, she's stronger than me, 10 times stronger than me, right? And I might be the talker and making money and trying to do this and the risks and that, but at the end of the day, it's like I'm going home and to bed with her and sharing all my woes with her. And I think that's just, you hit the nail right on the head with that, and having a partner and a partnership, most importantly. Because again, I find so many, what did I say too, like, if you're not financially where you want to be, there's a lot of boxes that you can look into. And I do think one of them is the mentality that you have, even with other people, right? Like with friends, with family, with girlfriends, the reason why you're dating, like being intentional. And this is something that from the very moment we've touched base, Colton, I've just heard the intentionality in your voice. I mean, it's very clear. And so it's like when you have the vision, that's where you're going. And it just sounds like you have the partnership. All the boxes for you have been checked with intentionality. And you're there and you're driving and you're making it happen. I'm sure the next deal is going to be 10 million. So there's a lot about real estate. There's so many questions, I can ask more about real estate. I want to dip in a little bit to the dividend portfolio because we have, of course, a lot of dividend investors watching the channel. I want to learn where you started with dividend investing, how, because you had your American Express stock, it took off, you made your 1,000, fantastic. And what was it that was like your inspiration to build a dividend investing portfolio?
For me, I think it was always just wanting to get that passive income, right? Rather it was a yearly dividend, a quarterly dividend, or monthly dividend, right? That was my biggest thing, is that if I'm going to own a piece of a company, I want to make sure that they're giving me something in return, not just appreciation, right? So that was my main thing. Now, I also own Tesla stock. I have a very big bet on Tesla, but I would say 90% of that portfolio is in just dividend ETFs, right? And dividend ETFs, why I like them is because they're safer, because you get a bunch of different stocks in one. So if one goes bankrupt, you're okay. It's managed by professionals, people that know a heck of a lot more in terms of, equities and all that than I do. But what I focus on now too is more like to cover call higher yield ETFs. And the reason for that simply is because, like I mentioned earlier, I have no problem with selling 300K worth of dividend paying stocks and buying a real estate deal.
Yep.
Right? So if I'm making between 8 and 10%, let's say a year getting paid a dividend, but my appreciation is only 2-3%. Some people are going to say you're losing out a lot of money, but the way I'm using it works for me.
Sure.
Right. And I also have growth on the side.
Sure.
Right. In Tesla, Apple, Shopify, and all that sort of stuff. So dividend paying stocks, it was just, I always wanted to get paid from something. That was my biggest thing, right? So Enbridge, I've owned Enbridge forever. all the Canadian banks I've owned and some US banks, right? Like I just always want to make sure I had a dividend. And for me, I listened to Warren Buffett 100% when it came to dividend paying stocks or stocks in general. Was if the stock market shut down for 10 years, would that company still be around?
Wow. Yeah.
So that's mainly what my portfolio is made up of. There is a little bit of risk in there as well, but that's just fun, play money.
Now, did you ever care about monthly paying dividend stocks versus quarterly or annually for some of those, that are out there? Did it matter? Does it matter?
It doesn't matter unless, to me, it never really mattered. I just want to get paid a dividend. Now, majority of mine are all monthly payers, but that's just because of the types of ETFs I'm investing in. But I have I still own stocks that pay quarterly, like SCHG. I own one of my retirement accounts. A couple of Vanguard funds. Apple, for example, I own in there too, right? But for me, now it's just the type of things I invest in pay me on a monthly basis. I prefer to be paid on a monthly basis because that's how I get paid in my real estate. So maybe I'm just used to that, but it really doesn't matter in my opinion, as long as you're getting a dividend.
Now, how much roughly, you can ballpark this one, how much roughly are you making in dividend income per month? I mean, you're the portfolio in and of itself is 600,000. Again, for those of you who missed the beginning of a dividend portfolio.
So last month, my entire portfolio brought in $4,900.
Woo! Wow.
Dividends.
And how big is the actual portfolio?
That portfolio, $611,000.
$611,000. And the holdings wise, what's your holding count in it?
What do you mean holding count?
Like how many positions are in there?
13.
13. Okay, so I'm assuming then the vast majority of them are in fact ETFs.
Yeah.
That are in there.
Majority of them are all ETFs besides common Tesla, common Apple, Shopify, a couple others. Yeah, most of them are all ETFs.
Can you give us the top 3 ETFs, dividend ETFs that you have in there?
Sure. So these are all in Canadian funds, so they're not necessarily available on the New York Stock Exchange. But
you're gonna make a lot of Americans grumpy. Right?
I'm sorry. It's Canadian. I'm sorry. But HYLD, which is a Hamilton fund, so invests in tech and the S&P 500. It also has gold exposure. And then I own HMAX, which is the big 6 Canadian banks, and it has Canadian utilities as well. If I'm going to go with, I guess the last one there is a broad ETF that just owns different sectors.
Sure.
But like I said earlier, I have over an $80,000 bet in Tesla that has nearly doubled now. Right. Yeah. So that takes up a fair portion of that portfolio.
I feel like every dividend investor has like a slice of Tesla somewhere in their portfolio that's just taken off, and it makes their portfolio look so much better.
Yeah. Well, I owned Tesla about 5 years ago, a very little amount. And again, I sell my winners too early. Right. Yeah. So I made sure that when it cracked under $150 a share this year, or I guess it was last year, I bought as much as I could. Yeah. Right. And we were blessed in Canada too. We have some called yield share ETFs. I don't know if you have those in United States, but they buy the Tesla stock or the Amazon or the Apple stock, but then they write cover calls on them and they use 25% leverage. So you get a boosted return. Obviously, there's a downside to it too if it crashes, but you get the monthly income with the cover calls, and then you also get the appreciation because of the leverage.
Yeah. There's your risk again right there. Take the risk.
Yeah, I'm very comfortable with debt, right? Like a lot of people might look at me and go, holy, you're in a ton of debt. But again, my real estate values, it's 50-50 loan to value.
Sure.
Right. So, and I don't think the stuff I buy now, which is multifamily buildings, they don't go up and down like your residential homes. Yeah. Right. It's based off of the property, right? Like I got 12 people in one building paying me rent. Right. So it's not going to go down 50%. Actually, during all this turmoil, that building has gone up $250,000 because we just got a reappraisal done.
Wow.
Because rents keep going up. This is why I love real estate, right?
Yep.
Tenants are paying down my debt.
Did you lose any tenants during that time?
Did we lose any? We had, over the last year, I'd say we probably had 3 evictions, 3 or 4 evictions. Right?
That's really not bad at all.
No, and a lot of it was inherited tenants that we bought from the previous owner who we knew were going to cause problems.
Sure. So you wanted them out anyways.
Yeah, so we wanted them out anyway, right? Since we own multiple buildings, but the tenants we've placed have always stayed.
Yeah.
Always.
Beautifully done. I mean, really, wow. So I'm going to cut back into this dividend portfolio a little bit more because we started talking with American Express, started talking about American Express, and you sold that stock. It was a success, and now all of a sudden it sounds like you got the dividend ETFs. Was there a time in your dividend investing journey that you started to load up on dividend stocks, or did you go from American Express to ETFs because it was just like, you know what, that's the safe bet here, and it's easier, takes less, time to do all the due diligence and invest? Or what was the process there? Like, how did you just narrow in on your ETFs now?
When I was in college, I tried to day trade. Horrible, right? Horrible. There were some winners. In 2015, Canada legalized marijuana, right? So there was a lot of money made there. There's also a lot of money lost there, right? So I probably never owned in my portfolio, never owned more than 20 stocks at a time. Because to me, again, I listened to Warren Buffett. I listened to a lot of these, these actual multi-billionaires, Peter Lynch and stuff like that. When they say just buy the S&P 500, buy the biggest 500 companies, don't have to worry about it. That's generally what I do. Now, in Canada, I buy the biggest companies in Canada, right? But then I also have exposure to the S&P 500. So there wasn't a time, like I know I've watched a couple of your podcasts where people have 60, 70, 80, 90 different stocks. Like to me, that just stress. That for me is risk, right? Like I just rather own the big 4 or 5 banks that I know are always going to get bailed out. I'd rather own Apple, because if Apple ever goes under, there's bigger problems than the $10,000 I lost, right? Like, so for me to bundle that all into one ETF, it's just so much easier, right? And for example, like a lot of these, if you owned a lot of the regional banks in the United States, you probably didn't fare too well, right? But if you had, like I invest in it's a BMO US ETF, bank ETF, and it holds the top, I think, 20 banks in the United States. 95% of it is JP Morgan, Citi, Bank of America. What's the other one you guys got there? Morgan Stanley, I think.
Morgan Stanley is a big one.
Right, 95%. The rest of them is the smaller regional banks.
Sure.
It didn't really go down all that much. It went down a little bit, it came back.
Yeah.
Right? So I think investing in ETFs was just a lot simpler. It was easier. It wasn't as stressful than watching a ticker all day because something happened in, I don't know, Australia, and it's affecting something in, Brazil. Like, to me, it's just individual stocks always gave me anxiety.
I've had several guys on the podcast with me that talked about their portfolio size. The more positions, the better. So Jason Fieber is one of them. Mr. Free at 33. And I don't know how many positions he has exactly. He has got a lot. I think he said when I interviewed him, it's like over 100. And for me, when I started building my dividend investment portfolio, first of all, I was inspired by Andre Jick, who I'm sure you know, fantastic YouTuber. And he started off always just showing his dividend portfolio. And I was inspired by the dividends that are coming in every month. And it's just, you show how many dividends come in, the totals, X, Y, and Z. And so when 2020 hit, I went from, just having my ETF, VTI there to, I think I had VTI, Apple at that point in time, Johnson & Johnson, Realty Income, very small portfolio built on like those positions. Then 2020 hits and everything was on sale. And it was like the matrix of like sales, right? I was like, I'm going to buy this, I'm going to buy this. And I kept buying any little deal that I saw in basically with the mentality that, follow the Jason Fiebers and the Andre Jicks. At that point in time, Andre Jick also had, I think, like 50, 60, 70 holdings. All right, this is what I'll do. I think that has been single-handedly my biggest mistake as an investor, because I bought, sure, a lot of positions, a lot of great positions. There are a lot of great companies, but some of these positions I've had like 3 shares. What's the dividend? 75 cents, right? So what I've learned from that is double down on quality. And actually someone just commented on one of my videos today that basically said that that's like the worst advice. You should be buying and buying and buying and loading up because, again, like the S&P 500, it will never fail. So buy as many positions as you can. And for me, I'm taking this Bill Ackman approach of trimming my portfolio. It's down now, I think, to like 18 or 19 holdings. I want to continue to trim, when the time is right to do so, and get down to like 10 to 12, three of which would be ETFs, indexes, and the remainder are going to be high quality individual stocks. My largest actually would be Apple. I'm curious. So you have your ETFs. What is your and it might be Tesla. I think it is Tesla for you. What is your largest individual stock? Doesn't have to be a dividend payer, but
it's an ETF. I have about 115,000 in the HYLD, which is a Hamilton fund. But second to that, it's going to be my Tesla bet. And because to me, when I saw the crash happen last year in tech, it made no sense.
Yeah.
Right. The reason why, and it was mainly because of Tesla. It made no sense just because he sold stock to buy Twitter. That was the only reason it went down.
Yeah.
There was nothing fundamentally wrong with the company, right? It was just he was buying Twitter. Once in a lifetime opportunity. And I made sure I took damn advantage of it. But I understood. This goes back to what I want to say was when you own 60, 70, 80 positions, you do not have enough time to read those annual reports, right? And did you fully understand each stock you were investing in? Did you actually understand the annual reports and all that? Well, probably not, right? And what a lot of people have to understand too is when you invest with a fund, like whatever it's an ETF or it's an index fund or whatever it is, you have professionals that know what they're doing, should know what they're doing, taking care of it. Because you have to remember, over the last, I can't remember the exact statistics, don't quote me on it, but over the last 50 or 60 years, majority of the companies that were in the S&P 50 years ago aren't in it today.
Yeah.
So if you're buying individual stocks, to me, you're playing with fire.
Yeah.
Right? Unless you're buying the top 10 maybe. But if you're buying 100 of the 500, you're probably going to lose more than what you could have just made if you put in Vanguard or SCHD or whatever it is, right? The Dow, whatever. So to me, I think the more individual positions you own that you don't understand, the more risky, right? I invest in the biggest 6 banks in Canada. It's one ETF. It's not each bank individual. One ETF that owns the big 6 banks in Canada. I know that the big 6 banks in Canada right now are doing good. That's all I know.
Yeah.
Right? Because all I need to see is that RBC beat earnings, Scotiabank beat earnings, right? Blank beat earnings. That's all I need to know. I don't need to dive deep into the financials of each one, right?
Yeah. No, I love it. I love it. Now, this leads me to the next question of timing the market. And I want to know, because you have different perspectives. You have the real estate perspective, and then you also have the income investing perspective. And so what I am always doing, at least I love economics. I also am a huge fan of Peter Lynch, who notoriously said that if you spend 14 minutes a year studying economics, you've wasted 13 minutes, but it's still for me fun to, read up on, and it's interesting, and it gets me thinking. And I do use economics to try to find the right sectors to look into and invest into, and then therefore better stock opportunities. I'd love to know from your perspective, and on both fronts, right? Do you at all consider macroeconomics? Do you try your best to, I don't even want to say time the market, right? Because it's not necessarily timing the market, it's just understanding what's going on at a macro level to start to look then myopically at different industries or real estate deals. Do you use timing at all in your process?
I would say rule number 1 is you can never time the market, but I do time the market. I essentially, when it seems too good to be true, it usually is, right? So for example, the last 3 or 4 months, tech has just been going up and up and up and up. Sooner or later, it's going to correct by 5 or 10%. What did we have yesterday and today? Well, Apple corrected like 2.5%, 3%, Tesla like 7%, right? So I guess in terms of that, I think I'm just more aware. Not to say timing, but I'm aware, right? So when I see that there's been a massive, when the market goes up 40% in 3 months, when you got 5 years worth of gains in 3 months, sooner or later, you're going to have a correction. And a correction can be 5%, a correction could be 20 or 30%, right? So I think it's understanding how I don't exactly know how to word it, because I think it's kind of a gut thing too. But when everything's going up and up and up, expect that there's going to be a downturn.
Just be
right? And for
cautious.
real estate, for me, it was very simple that when they said we're going to need to raise interest rates, I think they originally started at 4.25% here in Canada. That was their target. I said, okay, they're going to do this,
Yeah.
and it's going to affect residential housing prices in small multifamily properties, right? So I guess in a sense, people do time the market, but I think when you're starting out, not to worry about it. I think just consistently buy, right, dollar cost average into the market when you're starting out, just to get your foot in the game, right? And as those dividends start rolling in, you'll start caring less and less about the day, week, month of the stock market,
Sure.
right? Because those dividends just keep coming in no matter what, right? So I would love to get to the point where I don't look at my stock portfolio at all. I know it's not going to happen because I'm just like focused on that, focused on like I have to be involved with it. But it'd be nice to get to that point, right? Just because that is to me would be like the pinnacle where I know that I'm invested in the best, 10 ETFs in the world or 20 ETFs in the world. I haven't got to worry, right?
Yeah.
So
I think what Warren Buffett always shares that when he passes away, that he would only ever recommend, right? Just like again, the S&P funds, the big funds never fail. And it's a takeaway. What I also think is a takeaway here from at least this snippet of the conversation is that even as a dividend investor, you are invested pretty heavily into some growth stocks. And I think that's important for a lot of dividend investors to take away is like, it's okay to be a dividend investor and also invest into 3, 4, 5 growth stocks because they, again, in this case, you have Tesla, right? I also have Tesla. I have Apple in there, which does pay a dividend, but let's be honest, what is it? 0.48 of a dividend yield. It's almost nothing, but it's the growth and the appreciation here that can skyrocket. I want to jump into a bit of a different direction. We have just a few minutes left here, but I want to ask, because of the intentionality that you have, I got to ask, what books have you been reading? What book would you recommend for investors out there or real estate? But have you read any books that really just blew your mind away that had so much wisdom within it that if we read it, we might be the next Colton Lukey?
there's a lot. Like when you said that you had the goal of reading a book a week, I had that goal, right? I never got to 52 in a year, but I think I got to like 40 something, right? So I've read a lot of books in my life. And the ones that stick with me, and one you mentioned earlier, Millionaire Next Door, that's good for mindset and understanding that millionaire is not about Ferraris and Lamborghinis.
Yep.
One of the first books I read was The Intelligent Investor by Benjamin Graham. It is a awful, awful read. It's horrible, but I've read it probably 3 times now. And
does it get better?
When I start to understand value investing. One Up on Wall Street by Peter Lynch. I think those are probably for the stock market sort of books are the big ones. In terms of real estate, I have a book called Your First House to Financial Freedom. You can read
Where can we buy it? Amazon?
Amazon, yeah.
Amazon. We can buy it on Amazon.
Some books that really helped me out were like Rich Dad Poor Dad. I think it's a normal one for everybody. There's a book that really changed my mindset of real estate investing, and it's by Manny Koshman. Not a lot of people know who Manny Koshman is, or that he has a book before his best-selling book. It's called Your Contrarian Playbook, $100 million Real Estate Portfolio, something like that. Fantastic book. I do have it. I think it's in my links in my description of my YouTube book or my YouTube channel. Man, there's so many books out there. I know that one I read recently was fantastic by Patrick Bet-David. I think it's called Your First 5 Moves. Fantastic. Sure. Grant Cardone books, love them. Right. I've read 10X probably 10 times.
10X 10 times.
The Millionaire booklet he has, which is like a very small booklet, that changed my life because it made me look at money differently. It made me learn how to dissect a million into smaller numbers, which made it easier to understand because I'm not a very intelligent person at all. I was a straight C student, so understanding numbers and stuff like that was difficult for me. So breaking it down really helped. Yeah, no, those books I would say probably some of my top ones. I do do a video every year of my top books. So
we gotta catch that as well.
Yeah.
Now I want to spitfire this question at you because I mentioned at the very beginning. We didn't really get to it, but I want to talk very quickly, like 30 seconds, 40 seconds on crypto. What's your thoughts? Give us like the 1-minute breakdown.
Crypto, in my opinion, is the future. I think Bitcoin is the top dog. So if you're going to invest in crypto, keep it safe and cold storage, mainly buy crypto or mainly buy Bitcoin, and then maybe dabble in Ethereum and a couple other projects.
And how much of it is in the portfolio of yours?
Ooh. I started buying Bitcoin in 2016, so
Okay.
a lot.
Well done, sir.
Yeah, I don't know exactly because I honestly don't look at it. It just
Yeah.
gets bought every week. I would say probably close to 100,000.
Wow. Wow.
Yeah.
And so just before I jumped on the interview, no joke, my girlfriend and I were sitting together. I was very excited about this interview because, again, you're 31 years old, you're absolutely crushing it, multi-millionaire, passive income, I mean, mastermind when it comes to dividend investing. And you have such a great story. As I was talking to my girlfriend about your story and, the interview, and she goes, well, if he's retired and he's so young, doesn't he get bored? And something that I already know from talking to you in this conversation right now, and also just interviewing other, passive income investors, it's not about just retiring early and sitting around and doing nothing. But I'd love to get your take. I mean, you are literally financially free. If you just wanted to stop working, you can relax. You did it. Like, you won. I want to know though, what is it like? What's your day-to-day like? And what could we expect for those of us who are on this journey trying to achieve financial freedom? What's it like?
Yeah. So first, I think everyone has a different definition of retirement. For me, it was being my own boss. So I'm
Mm,
still working. I'm trying to build a real estate portfolio. That's my job now, right? But it's mine. What it's like, financial freedom is great, I guess. In simple words, it's great. You have your time to do whatever it is you want on a daily basis. For me, I get up, I have a cup of coffee, I usually start answering emails, and then I go for a walk on the beach. I live 5 minutes from a beach, right? Go for a walk on the beach. I come back, I go to the gym, and then my day really starts where I'm working on rather driving up real estate properties. I'm doing what I love. Being
sure.
financially free, you're able to do what you love. For some people, that's going fishing, that's going hunting, that's drawing, that's whatever it is, landscape, whatever it is, right? But being able to not have to go into the office every day, 9 to 5, brings you a lot of happiness, but it can also bring you a lot of stress at the same time. And the reason for that, the stressful part, I want to get into this, because I talk about this on my channel too, is we have multiple, when we first got started when I first retired, it was just lean fire, right? Like lean, lean, lean.
Yep.
So I had a duplex, tenants moved out. That was stressful because that was $800 a month coming in. That wasn't coming in anymore. So there is stress in financial freedom as well. But what you want to make sure is that get to the level so that you can then dedicate 100% of your time to making money for yourself. Dividends, YouTube, other businesses, real estate. That was what I wanted to do. I wanted to get to the point where I could pay for the day-to-day expenses, but then focus 100% of my time on the real estate business. And that's what I did. And that made me happy. And I'm still happy to this day, right? Stressful at times, right? Obviously with deals and stuff like that. But the joy of financial freedom, I'll never get bored. And I'll never stop working, I don't think. I'll never stop investing in real estate. I go away for 2-3 weeks. We go to Colombia. I'm like, oh man, I want to look at this property. Like, what am I doing here, right? Like,
Sure.
yeah.
You do what you love. You never work a day in your life. I almost feel like I should call out to my girlfriend. You hear that? He's not bored.
Not bored at all. No, I'm complete opposite. I have it's to the point now where I got so much going on that we hire cleaning lady, right? We're hiring people to cook us meals. We're hiring people to do things they do all of our landscaping and lawn cutting, right? Because it's funny, I'm financially free, but it's like my time is less and less because I'm focusing on things that I love, things I'd rather be
more
doing.
money, more problems.
It's not more problems though. It's for me, I don't want to cut the grass. We live on 3.5 acres.
Yeah.
I don't want to cut the grass. Tear it up. I don't want to clean my house, but that's what financial freedom gave me, right? It gave me the ability to focus my time on making money on the business so I can trade that for my time back, right? Like I can trade that for those things I don't want to do.
And you couldn't have said it any other way that I think is just picture perfect for what financial freedom really is. It's buying your time back And time is the one commodity, if you want to say, that you can't get back. I mean, you really can't. It's gone, it's gone. And to buy it back and to know that you've done it from, now 28 years old, 31 years old now, you've bought your time back, you have your freedom. And the key takeaway for me here is you're working harder. You're working harder and you're doing more and you're enjoying the whole process. My last question for you here, Colton, is what's next? Like, what's next on your journey? And it doesn't have to be real estate related. I mean, what was it? George Bush, after his presidency, became an artist. Right. I don't know what Obama's up to, but I think he's writing books, right? He's lecturing. What's next for you now, or is it just the focus on real estate?
Well, I have goals still, obviously, and the goal is I want to write another book. I want to travel the world with my wife. I want 1,000 rental units. I want $1 million dividend portfolio. I want to be healthier. And yeah, I think those are the goals still, right? Those are them. And slow and steady wins the race.
I love it. I love it. Slow and steady wins the race. A man with goals, and he's still going strong. He's about to become even more free. Investors, Colton Lukey joining me here on the channel, talking about financial freedom, passive income, real estate investing. He is free by 28 years old, now 31 years old. Colton, I wish to have you back on the channel at some point, hopefully soon, have another chat. Maybe when the market tumbles down, you help us out with real estate deals.
Absolutely. It'd be a pleasure, man. I love this.
But thank you so much again for joining me. And until next time, investors, we will see you all there.